Good day, everybody. This is Jim Sloman speaking. Obviously, the big elephant in the room is the $600 billion of new fiat money that will be created by the Federal Reserve Board in the U.S. over the next 8 months. But mark my words, there will come a time when we will look back on the $600 billion with a certain nostalgia because it will seem so small. In fact, the real number is actually larger than $600 billion, since it doesn't count the repurchasing of expiring mortgage securities already announced. The Wall Street Journal estimated that the actual amount of newly created money by the Fed will be about $110 billion a month, which happens to be almost exactly the amount of the federal deficit each month. The Fed is monetizing the deficit. Funny. I always thought that only banana republics did that. Let's take a look at some charts here. This chart goes back to about 1780, and you'll notice that from 1780 to about 1913, 1914, when the Federal Reserve was established and began operations, the U.S. dollar was on gold standard, and you'll notice that it maintained a rough equilibrium in its purchasing power. Once the Fed got started, we had then Roosevelt took the dollar off of the gold standard domestically, and you can see that the purchasing power of the dollar started a decline, which after Nixon took us off the gold standard internationally in 1971, basically removed the last links to gold. We had a accelerating decline in the purchasing power of the dollar, which is continuing to this day. Now notice these are nominal figures, M2, M3, GDP, and so forth. Let's look at the process. The first thing I want you to note is that this is not to scale in terms of time. This stage one has actually been taking place in the United States for the last 30 years or so. And this stage two will actually take place, in my opinion, within a few years, almost at any time within the next few years. And this middle stage right here is the 2000s. In other words, stage one is a good time stage, as marked by the 80s and the 90s in the United States. Then the 2000s are this in-between stage here, and we're just beginning this stage two where things really take off. The first thing to be noticed is that these things here above zero, this is GDP, this is asset prices, this is money supply, this is price inflation. These three are all nominal prices, that is, prices as reported. The equivalent, what's called real GDP, is that same thing adjusted for inflation. Here we see asset prices such as the stock market or commodities, again nominally. Then down here is that same thing adjusted for inflation. Here is the nominal money supply, or the money supply as duly reported by the government. And here is the real money supply adjusted for inflation. And here is price inflation, and here is the real value of the currency, which, just as this goes up exponentially in stage two, the real value of the currency goes down exponentially in stage two. But you'll notice that in nominal terms, things are going up rapidly. But in real terms, adjusted for the increasing inflation, things are going down rapidly. Even the money supply, nominally the money supply is increased faster and faster by the government. But in real terms, adjusted for inflation, the standard cry as inflation gets worse and worse in virtually every historical society that's gone through it, is that there is a shortage of money. And due to that shortage of money, because the prices of things are rising faster and faster, and what happens is that the velocity of money in this stage two increases more and more rapidly as the public begins to expect higher and higher inflation. And so even as the government is increasing the money supply faster and faster, the rate of inflation actually starts increasing faster than the money supply, no matter how fast the government increases it, because of the velocity of money, which means how fast it passes from one hand to another in business transactions. The effective supply of money is increasing even faster, and so the rate of inflation is increasing even faster, which means the value of the currency is decreasing faster and faster. This is the CPI, the Consumer Price Index, as reported by the government, and as a number of commentators have noted, the Consumer Price Index has been heavily manipulated since 1980 in order to make it look better, lower, than it actually is. And shadowstats.com by the estimable John Williams has taken it upon itself to compute the CPI as it used to be computed before 1980, before successive administrations further manipulated the CPI figure as well as other figures. It could be noted that one of the first casualties of an inflation process is the truth coming out of government statistics. And if we look at this, we'll notice this is the true CPI. We'll notice it's been steadily increasing over this period of time here, and is now at about 8%. 8%. The official rate is 1% inflation. If the real rate of inflation in the U.S. is now 8%, that's really high. This is annual growth in gross domestic product. And again, as you'll see here, this is the official figure released by the government, which shows that supposedly we're still growing the economy. Shadowstats.com has calculated what it would actually be if it was computed as it used to be. And you'll see that it is negative, not only negative, but it is on a clear downward trend, which corresponds to what we're seeing here. That is, nominally things like GDP go up, but in real terms they go down. And nominally asset prices go up, but in real terms they go down. This is a wonderful chart by Jeremy Grantham. This goes from 52 to roughly 1980. We can see here that total debt stayed roughly the same. Slight increase, but roughly the same. And GDP was growing at 3.4% per year. Whereas, starting around 1980, debt, as you can see, started increasing, and then increasing at a more and more rapid rate, and yet GDP averaged 2.4% per year, showing that adding more and more debt to the system does not increase GDP. It actually, beyond a certain point, becomes more and more burdensome and actually decreases gross domestic product as that debt level keeps on increasing. This chart is courtesy of calculatedriskblog.com, and it shows the different percentage of job losses in post-World War II recessions aligned at the maximum job losses. That is aligned at their maximum here. And you can see that most of the earlier recessions recovered quite rapidly, whereas this one, for instance, this one in black here, which is the 1990 recession, recovered much less rapidly. This one, the 2001 recession, recovered much less rapidly. And this is the current one, which basically is not recovering at all. And as you'll recall from the last time, the official rate of unemployment is about 9.6%. But the actual rate of unemployment now, as calculated by Shadow Stats, is about 22.5%, really a dramatically high rate of unemployment. Another very interesting chart this is courtesy of the Case-Shiller Index and the New York Times.